This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello and welcome back to another episode of the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. And man, what a crazy week it has been as earnings season continues to unfold, bringing plenty of big moves with it. I'm joined this week by Claude Walker from Ethical Equities. Hi, Claude.
G'day.
And Matt Joss, back from the land of the long white cloud. Good to have you back, Matt.
Thank you, Andrew. Very happy to be here.
How was your trip?
It was excellent. Thank you very much. Yeah. Met with a few companies, a few other investors, mostly kind of tech themed.
Ooh.
So yeah, it went really well. I'm going to write it up for mattjoss.com, so that'll be coming out this weekend if you want to subscribe there and get it when it's fresh.
Nice. Hot off the press.
Yeah, absolutely.
Oh, looking forward to that, man.
Yeah.
So we had a bit of speculation last week. We were talking about Altium,
Yeah.
which for some reason Andrew and I both neglected to buy. Were we correct in thinking that you own that one?
That is correct. I do own that one.
And when
I've
did
owned
Well,
it
let's
for a
not
while.
dwell
When
on
did
it,
you
guys.
buy
Let's
that,
move on.
Matt?
I'm
Could
sick
you
of
please
talking
tell
about
me
it.
when you bought that
It
one?
was a few years ago, a few 100% ago. Yeah, no, it was a good pop, wasn't it?
Did you get a spiffy pop?
Probably close to a double spiffy pop.
Ooh,
Yeah.
and just we better define that for people playing
So a
along at
spiffy
home.
pop is when a company increases in value in one day by more than your original cost base.
Oh, it's such a nice feeling, isn't it?
Anyway, yeah, it's pretty good.
Who
Well,
would have thunk it?
while we have you here, speaking of crazy, insane returns, another tech-themed company that begins with A and one that you also hold had its results out this week. Do you want to tell us what that company is and why the market went so crazy for it?
Yeah, sure. So the company is Appen. So Appen provides the data that goes into AI products. It's their main product now. They started as more language translation. And that's a booming market, and they're actually the world leader in providing that data for all these AI giants like Google and Facebook to hone their services. So it's a company that I've owned for a while. Originally bought a bit under $3 and went up by about $4 on Monday, so another spiffy pop, which was quite happy. And yeah, so the results were really strong though. So revenue was up 119%, profit up 133%, and a core part of that, the market's love of it, is that it's been upgrading guidance consistently and then beating that guidance that it's given. So it started off in February last year giving EBITDA guidance of 50 to 55 million.
So that's just operating profit
yeah.
before tax and a few other things.
And then at some point upgraded to 54 to 59, then 62 to 65, and then finally came in at 71.3. So beat all of those estimates, including one that came out in December, I think.
Wow.
Which the market loves, right? Like the market in a lot of ways is just an expectations
You
machine.
don't even know how good you are. Which, to be fair, is kind of true, right? Because one of the things that I thankfully actually own this one, but one of the things that kept me out of it for like ages, way too long, was that the founders were selling down shares. So this is like a counter example to that.
Yeah, founders who aren't currently
Good point.
CEO, who'd basically a couple actually from Australia who'd started this company, and I don't know if they ever had a vision for being such a multi-billion-dollar company, but yeah, so they were selling down their position. It makes a lot
Right
of sense
place
to
at
me.
the right time. And
Yeah.
not to take anything away, but I mean, again, it always gets billed as this AI company. It's like, well, they're not actually doing any AI themselves. They're providing the data
Very-
sets to feed into the big tech companies that are doing AI. And one of the I guess bear cases that I often hear come up is like, well, why are these massive Silicon Valley giants relying on this relatively tiny Australian company to come up with their data sets? I mean, anyone who's using, Facebook is eavesdropping on us all the time, allegedly, so is Google. Why do they need to even bother doing that kind of stuff?
Yeah, it's an interesting question. So I guess the first part is just to completely agree they're not an AI company. I think that at points people can get too excited about the business because they think that it is an AI business itself. It's not. It provides the data for that, which is important. But they have hit quite a critical point in scale. So they have 1 million contributors now to their platform around the world. So it's 1 million people who can do these jobs, which can be tagging images, is this a car, is this not a car, all sorts of things for different algorithms to be optimized. So they have a lot of scale advantages.
Teaching computers how to eventually destroy us.
Yeah, exactly. And a good pedigree of working with high-name clients. They started with Microsoft, did a lot of language translation stuff with them, built a great track record now with Facebook and Google. So it's a reputation plus scale, I'd say.
Yeah, that's a
Nice answer.
That's what it took me too long to sort of cotton on once they started adding to their customer base. that's when that was maybe the inflection point that you might have attracted you.
And they made a really great acquisition over the last year, LeapForce, which is their biggest competitor.
So my question was, I wanted to know not just about LeapForce, but I think there was also an acquisition in 2016. And LeapForce, I just wanted to know what you think of the acquisition strategy, and is there any risks around that?
I think the other one might have been a much smaller language translation related. The LeapForce one was transformative. I think it's a good question though, because it's not part of my strategy for them to be acquiring regularly.
Yeah.
But I think the LeapForce one was just what you'd imagine is a perfect smart acquisition, because it was quite a different competency to what Appen had. So Appen had quite a big scale and this good reputation, but they had a lot more labor intensive process. So that means their margins were a lot higher. Whereas LeapForce probably wasn't as good as going out and signing up customers, but they had a very efficient operation.
You mean the margins were lower?
The margins were, they're at LeapForce, they automated almost everything.
Right.
So that they, if you apply kind of Appen's business with that operation, the margins go up a lot, which is what happened this year.
Gotcha.
So it's kind of like two different skill sets that have been married quite well. And different customers as well. So they added Google as a customer.
Has it been long enough to say that for sure, or could this just be the honeymoon period, as it were?
Yeah, it's been almost a full year, so I think it's pretty close. But it's an acquisition. There could always be some things down the line, but it seems to be going pretty well. And the former LeapForce people had stayed on at Appen, so it seems to be a really good acquisition that's worked out well. And so just wrapping up, they're guiding for 22% EBITDA growth. That's their forward guidance again for this year. And they're investing in their engineering team about $6 million, so that's including that kind of extra spend on engineers. So
that's potential moat building, isn't it?
Yeah, exactly. This company is still very high risk because they have a lot of customer concentration. A lot of their customer, Facebook's still a major customer for them. If they walked away, that could be disastrous. So got to keep that in mind. But yeah,
I feel like you build a moat and you dig a hole.
Any engineers out there, send us an email. Do you dig a moat or do you build a moat?
Well, both maybe.
Wait,
one last question on Appen before we move on. Do you still think the price is good, or has it got ahead of itself?
It's a good question. It ran up quite a bit on Monday. I haven't finished my intrinsic value estimate for the company, so maybe one to come back on. But it's not unreasonable. So it's about 40 to 50 times earnings, but it's been growing earnings so extremely fast and guiding for 20% growth. So just on that rough number, it doesn't look too crazy for me. Again, if they don't lose any major customer, which I don't think.
One thing that you reminded me of there when you were talking, we're not going to talk about it this week because we're going to try and run through a heap of companies, but WiseTech was another company that had a very, very strong result. And pretty much in line with their guidance. They reiterated guidance. In fact, today they increased their guidance a little bit. But shares reacted in a very different way. And I think one of the explanations for that is that WiseTech was a company that just continually put out this wonderful guidance and then beat it and then beat it. And then so it's this bizarre situation where they actually achieve very, very strong guidance and the market doesn't like it. Do you see that as, I guess this isn't so much a risk, just like the craziness of the market, but is that something that could potentially help knock a bit of that premium off with Appen?
It could do, yeah. I think for me, like all of us, it's really about whether the underlying thesis is still good, if the business is still doing really well, because I bought quite a bit more Appen when it fell to 12 and then $10 during that kind of panic. Like that was one that everything was still very bullish for the business. So that it can give you opportunities. Obviously, it's like the cliche to say. But for those businesses, I'm less concerned about that risk. But it is more of a risk. Like WiseTech's much more richly valued than Appen ever was, just on a multiple basis.
All right. Okay. So let's move along. Claude, you're up next. What are you going to talk about? What company?
M&F Group. I'm going to talk about one that goes down.
Oh, okay.
These things
just
happen.
in the interest of balance, it happens to everyone.
Yeah, actually, it was only down 9% today. But of course, the bad news is it's down 9% on its actual earnings, which is, I guess, a reflection of how the market felt about that.
So this was an unexpected result.
Well, there were elements of it. Elements of it were expected, but it was worse than expected.
Okay.
That's why the share price went down. I actually thought that the fall was pretty modest. I'd actually estimated in my mind, I thought it would be at least a 15% fall based on those results.
So let's back up just quickly. What do these guys do?
Yeah, so these guys actually quite an interesting little business. You don't see that many like this. They've cobbled together a few different business lines in the telecommunications space, in particular voice. Now, the reason that I own very few of the shares now and used to own a lot more, is because their growth engine is wholesaling voice minutes and connectivity to sort of mobile phones and landlines.
So they're a wholesale network.
But particularly focused on VoIP, voice over internet protocol. So if you can imagine from Skype, you want to call a mobile or a landline, which you can do, they need to have connectivity through someone like M&F Group. And that's also true for any of the other software platforms that allow that, you know, whether that be an online conferencing thing or a workplace tool, or there's just so many of them spreading throughout the world. It's increasingly how people work and communicate with each other. And of course, a lot of that is just connectivity app to app over the internet, but you still need that ability to call numbers. And that's what M&F Group can provide. And that part of their business actually grew very strongly and continues to grow
That's
strongly.
been going great for a long time, right?
So yeah, there's that. And basically they're increasing the reason I love this part of the business is because it could also be like a small new startup telco that needs their services for mobile plans or whatever it is, whether it's an app, whether it's mobile plans. If they're providing these wholesale services to other businesses, those businesses use their capital to grow the business. Sometimes they don't even make money. But M&F Group does.
Actually, it's not just those guys. If memory serves me correct, I think the Tasmanian government uses their network.
Yeah,
as
so
well.
that's another. So it has, as I said, it has several different business
You're right.
lines. So I talk about more the bit that I like, which
Yep.
is the wholesaling bit. That's because it grows with other people's capital.
Right.
The enterprise stuff is good, but that's more big companies and government. There's good margins on that, but it's pretty lumpy as it grows. They're forecasting good growth on that. That's probably one of the things I'd worry around because these sort of projects can easily be delayed for one reason or another. So I take the bit of the business that I like is this wholesale part. There's also retail, which they're trying to have a crack at. They've invested in. They've
Is that
actually
Pennytel?
So Pennytel's part of it. That's also been losing money up until now and still is losing money. They were a little bit too optimistic in terms of how quickly they thought they would reach break even. So this part of their business isn't firing. The broadband is now losing money as well. So like this retail side's really not doing too well. And also they've got the global wholesale, which is minutes, which is sort of quite a complicated business that I won't totally get into, but it's not really growth because as you can imagine, on a whole full global level, there's less voice minutes, or at least as a percentage for all the communication because so much of it is going online. There's still some, it's not in massive decline, but it's not really massive growth either. So that really surprised the market that it came in less than what the company was forecasting. They are now forecasting that they're going to get a very, very strong second half, which is possible because they did an acquisition for which they only benefited 1 month in the current half.
So they get a full 6 months.
They get a full 6 months of that, so that could help. And that's an acquisition in the good part of their business as well, so high hopes for that.
But you sold out. Oh, and I just finish that thought though. They actually said that, and they also maintain their guidance for the following year because they've actually gone out
So
2
putting
years.
aside that for a second, so I did sell. I tweeted, pretty much on Open, like I'm selling most of my M&F Group. I sold by far the majority onto Open at $4.11 or whatever. This was pretty lucky for me because I basically read and thought of it and basically said, well, I still really like this company and I would definitely buy back shares at a certain price, but at a price of $4.08 was about 20 times the bottom end of their 2020 guidance. And that's sort of ignoring for a moment the fact that they're now much more indebted than they've been in the past.
Right.
So to me, that seemed like a reasonable price to sell just because they've now downgraded their guidance. They've missed guidance. They've disappointed in terms of their ability to estimate. That might not be their fault. It can be a genuine error, but it's hard. But it just goes to show they could still make that genuine error about what they do in 2020. Look, at the end of the day, I would, if the company bounces back in the way they're going to in the second half, I would potentially consider buying depending on the price. Definitely looking to buy at the right price, but at a price above $4, I was happy to take most of my holding off the table, unfortunately, because I think it's a great company and I'd like to be a buyer again. But
I can see why you think that. I was just having a quick look while you were talking then. I mean, over the last 10 years, these guys have grown their sales at about 36% per annum. Dividends have grown, it only goes back 5 years here, but 19% per annum. Like Rene Sugo is the founder and major shareholder. He's a very good operator. He's delivered exceptional returns. So hopefully this is a bit of a speed bump and not the start of something more permanent. But to your point, you're going to wait and see before you're going to dip your toe back in.
Yeah, even how they just handled this disappointment. They had in a table for their presentation the old guidance, the new guidance, and the change. They're like absolutely drawing their attention to the fact that it's a guidance downgrade.
Very honest people.
That's good. It just means that they don't send people on a run around and checking back what were the old numbers, blah blah blah.
Okay.
So yeah, and they look on the conference call. One questioner actually thought the free cash flow which is a free cash flow, negative free cash flow this half. Mm-hmm. He thought it was better than it actually was, and the CFO corrected him and said, well, actually, free cash flow was worse than that.
Yeah,
so look, it's definitely one that I would buy, and I think it's investable, but yeah, it was a price issue for me.
All right, cool. Let's crack on. My turn.
Andrew, yeah, why don't you share some good news?
So some very good news. Nanosonics, we've talked about it before on the podcast. These guys do a nano. I just love saying nano-nebulant disinfecting because it's a very cool sounding term. But basically, these guys have just delivered stonkingly good growth. Revenue was up 36% or so. Pre-tax profit up 195%, which was really, really, really strong. So if you go back to that first podcast that we did on, this is a razor and blade model. This is a printer and ink cartridge kind of model. So the installed base that these guys have of these, they're a one product company at the moment. That's going to increase maybe another 16, 17 months time. But of this one product that they've got, they increased their installed base by a very solid 20%. And even more impressive, there was a close to 60% increase in the consumables, the razors, or the printer cartridges.
How much was that, sorry?
60 or 59% increase
nice.
in the consumables. Why that matters? Well, one, it's by far the higher margin stuff. Two, it's the much higher quality revenue because it's the recurring in nature. It's extraordinarily sticky. Three, it's got massive pricing power. In fact, one of the things to really watch with these guys is that they had a distribution agreement with GE. Which goes into a new phase at the end of this financial year, which means they're going to have much more volume and much more margin on that kind of stuff as well. And it's the majority of their earnings already at 60%. So everything was really, really, really strong there. The market went up by a crazy amount. So, before we get too much into the love in here, I'm at a point now where it's as much as I love this company, and I've been with it since 90 cents or so, and I'm very reluctant to ever sell on it. I'm finding it hard to wrap my head around the valuation. It's one of these.
Are you tempted to sell? Or
I am, but I've also got that ProMedicus experience in the back of my head where I'm very mindful. Drink. I'm very mindful that when you have extremely strong, fast-growing companies with a huge greenfield opportunity, a big competitive lead, a massive ability to... You can be, quote-unquote, too clever and too value-focused when these companies can be very exponential in their growth rates, and it's just very, very hard to do, so you don't want to overthink it. Having said that, this thing is on a prorated 15 times sales, which is up there. Their enterprise value to EBIT, so for those playing along at home, it's like another way of saying their price earnings ratio is about 100 on their forecast numbers, making a few assumptions. That's really, really high. And again, we've seen, I'll talk about ProMedicus in a moment, in fact, and Appen and all these other ones. Again, you look at those traditional measures and they all look stupidly
but this
crazy,
is
right?
Nanosonics. It's not a software company.
It
does hardware. Look, it's
company.
Razor plus Blade, which we love. And I don't know if we've mentioned, I think we did cover Nanosonics previously.
We did,
yeah. So
Andrew talked about putting things in the kiln, and we all had chuckling. As you do, you put things in your kiln.
But so this is
living in the past, man. Move on.
Let's step back. What did we actually think of these results? Were they were actually quite good.
The results
revenue
are
was
fantastic.
up. Put aside the price for one moment.
Yes.
The profit was up, record half of profit.
Yes.
the revenue was up, record half of revenue.
Yes.
And we haven't even had the uplift that's coming when they get to have more of their margin from their consumables.
100%. And this business remains debt-free, and their massive pile of cash grew even larger.
And they have free cash flow.
Yeah,
And
$71 million in cash as well. Super solid business. I would class it as close to recession-proof as almost as ProMedicus. Very, very, very high-quality business. Nothing wrong with the business whatsoever.
Yeah, but hold on. So look, we've got one hand, the business is good, right? So now we've seen this big share price pop. We've been used to being at around $3 or even $2.50 for quite some time. Yeah. It's been bumping around, and now it's shot up to $4. But one thing I've noticed, which I know I've been going on about for years on Nanosonics, is that there's been a bunch of short interest, and they've been shorting it around.
Dumb stock to short, honestly, of all the things to short. Funny. Anyway,
and I quite like shorting things, but I'm like, come on. Yeah. Anyway, but the point is, this was between $3 and $2.50. They're kind of shorting. It gets up to $3, above $3, and
we never figured out what the short thesis was.
Well, we managed to try. They did some good results. There was this short squeeze. It went from $2.30 to $3.50, then back down under $3, and now again, and I've just checked, and short interest is going down now. Over the last 2 months, short interest is going down. So these guys are buying back their shares at higher prices. Basically, they're not making money on this.
My heart bleeds for this.
And now there's 6% of them still short, and the shares are $4. So they, are they going to capitulate, or are they just going to hold on? And
I don't know. So, I'll give you some negatives though. The first one is that I quoted some very strong percentage gains there. The half that we're comparing it to was depressed. And the reason it was depressed was this was just prior to the release of their upgraded Trophon 2 product.
Okay.
So we had the resellers running down their inventory, and we had customers delaying orders.
Yeah.
So when you compare the sales to half year 17, so 2 years ago, it's only 12% higher than that. So annualized, that's about a 6% growth rate.
But that's a 6% growth rate on the high water mark.
It is, and I'm not taking anything. It's a very solid result, but I think it's a little bit spurious when you kind of sort of see this, and they make a big song and dance about.
So I agree,
it's
though.
Depressed,
so it's getting ahead of itself,
and the growth rate is slowing as well. Now there's inevitabilities with that as companies get larger. But this is where it comes back, and I need to move on because we've got a lot of companies to cover, but this is where I come back to the valuation perspective. Claude, as you know, I wrote an article for Ethical Equities. We'll put a link to that in the show notes. It'll go into much more detail than I'll give here, but I just, as much as I like it, as much as I still own it, I really have to squint at that to kind of make sense. Shall we move on?
Yeah, sure.
All right.
Wait. So are you going to hold on to all of them?
That is my intention.
Because I'm thinking I could see myself selling some Nanosonics. I could see myself selling potentially anything, but it's a great company.
You know me.
I think it's gotten a little ahead of itself, basically.
It has. I'm super lethargic when it comes to a lot of these selling, and I think that's actually on a net basis done me very, very well. And I am legitimately holding this because I believe in the year 2029, 10 years from now, it's going to be, like the next Cochlear. So I don't want to be too smart with this kind of stuff.
The next Cochlear.
And there's never a risk of me being too smart as well, let's face it. So,
if it turns out to be the next Cochlear now, you've got bragging rights on that.
Hey.
Otherwise, we'll come back to this.
Otherwise, let's not talk about it. Let's go from nanonebulant sterilizers to
a different kind of
dubious health claims.
A different kind of medical technology and panacea. That's a good link, actually, Andrew.
This is not medical advice.
You can pour it on anything, a wound, it'll heal immediately, I've heard.
Again, not medical advice.
This is evil spirits.
This is vaccinations.
This is A2 Milk, a company that I've talked about on this podcast before.
You have indeed, sir.
So it had results. They were pretty good. So revenue is up another 41%. NPAT up 55%. And so the shares moved up, I think, about 10% or something on the news, which is quite good, which is close to a double spiffy pop for me, which is the other part of the story. So it was an interesting result also, just like looking back on the past few years. So I first bought this in November 2015, 78 cents New Zealand. At the time, the market cap of the whole company was about 490 million. Wow. And in the most recent half year, they did $217 million of operating profit, EBIT, not even EBITDA. And they have $280 million of cash and another $280 million they own in another listed company, Synlay. So it's pretty good.
Anyway you want to cut it, that's some pretty
much
growth.
within 3 years,
milk.
3.5 years, they've gone. They're almost doing their entire market cap and operating profit.
Can I use the Donald Trump China again here? Is that part of it?
No more Trump stuff.
I figured it out now.
Please no. I'm going to start cutting in like techno music or something.
How much is China?
Huge part of it. So they're still growing in Australia. They have like 11% share of milk in Australia, as you've seen probably in the supermarket.
Yep.
Check it out. Buy some if you're considering. But yeah, so that's fine. But then what really took off was they positioned themselves as a premium brand for infant formula, which obviously went crazy for Chinese mums. They wanted to buy the best brand in Australia, and they kind of won the battle. So today in Australia, A2 has about 35% share of all infant formula sold in Australia. That's gone from 0 to 35% in just 3.5 years.
So what's happened to Bellamy's in all this? I should disclose I own Bellamy's and A2 milk. Okay.
Yeah, I mean they got into their own kind of trouble, I think, around their supply. And committing and then stuffing the channel was probably the big thing. So
explain yourself for those that don't know.
Yeah. So they had some agreements around supply. So they had take or pay agreements where they had to buy a certain amount, which is great because they were growing so fast. Yep. And they used that to sell into a reseller, a large amount into one reseller, who basically took more than they could take and then dumped it and kind of lowered the price, which hurt the brand reputation. Right. But at the same time,
it was false sales, really, isn't it? It's
it's kind of like
not reflective of end user demand.
Yeah, partly. Yeah, there was still good demand at that point, but they kind of went into one person who offloaded it all before Singles Day and kind of hurt the brand. And the company just, the CEO left a lot of other things, and A2 just kind of sailed straight past during all this. They've always been investing heavily in marketing as well. And they have that their premium brand established in the milk, which I think helps them a lot. Like a lot of people in Australia are buying that milk. It's like the premium brand for milk in Australia, so it helped add to that brand as well.
But this is the weird thing for me, is though, because in the shops I go to, you have your average milk, you have the A2 milk, which is 50 cents more or something. And then you have organic milk, which is like $1.50 more, $1 more. So in my mind, organic is the most premium one in the milk we buy in the supermarkets. I, for one, am like, I'll take organic over a magical.
What, synthetic milk?
But then, apparently, so we're told, and evidently true, in baby formula, A2 is ranked above organic.
Yeah, I guess so. I mean, I'd say we shouldn't probably think about them as the types too much. Like, it's not like, I don't think all the Chinese mums are thinking about what the A2 protein is doing. They're thinking about what is the premium brand in Australia. So I'd more take, it's magic. I'd more say that it's like the A2 brand is doing better than the Bellamy's organic brand, rather than that whole thing as much.
So you think it's all just rubbish, really?
No, I think it's magic. I've been telling you guys
it's a lot of fun. I don't own any.
I'm curious, what kind of milk do you buy, Matt?
A2, absolutely. Do you think I'm going to put poison in my body? What's wrong with you?
Again, not medical advice. This is it.
I feel sick just thinking about it all the time. Anyway, so I should wrap up a few other things. So the other big stuff, so China label sales, so not just the Daigou, direct into China, was up 83% and was over 170 million in the half year.
I haven't looked. Is that a low base phenomenon? Or
it's pretty big. So 170 million out of their 600 million of total revenue as a company. So pretty big chunk and growing 83%. So one of the fastest growing segments. The other big good news was US, where revenue's up 114% off a low base, and that's primarily fresh milk.
Yep.
But they're growing very fast recently. So in June they had 6,000 stores. In December they had distribution in 10,000 stores, and as of end of Jan, 12,400.
Afterpay kind of growth.
It's big growth. It's still milk, and so it's fresh milk as well. So it's like harder. There's a tougher supply chain.
Definitely.
But it seems like that's going pretty well, and if that goes well, that could like open the door for another market for infant formula as well.
Do you? And again, this is not intended as a leading kind of question, but another company that had a lot of success and profit off the back of Chinese demand was Blackmores. And we won't have time to get into that today, but that really fell flat on its face this reporting season. And we know that consumers in general are fickle, and like the Chinese are no different on that front. Is there a risk, or I guess it is a risk, but how do you think about that if consumer tastes perceptions change,
Yeah.
is that an instant sell, or how do you think about it?
Yeah, it's definitely a big risk. They're not trading that expensive now. They're on about 36 times earnings if you just double the current half's earnings,
Right.
Which isn't too crazy.
It sounds high in a lot of ways, but relative to the growth is
50% revenue.
Relative, it's not
growth,
Nanosonics kind of types.
God, I just checked in on Blackmore's. They also just had a CEO resignation apparently.
Yeah, Blackmore's has had a really bad.
That was today.
Yeah. Blackmore's not going well.
Bo-bo!
So A2's really reinvested in the brand consistently. They're always giving kind of something negative in their guidance, like we're going to spend more on marketing.
Yeah.
And the just kind of the prevalence of the mother and baby store sales they're doing there, I think is good. But it is, Chinese consumers are even more faddish, from what I understand, than Western consumers. So it could all change in future for sure. You just have to try and keep your ear to the ground and see what's going on. But it's going
I hope that goat formula is the next one.
I've heard that too.
Imagine.
I don't know. That's like a devil's milk. Wasn't the goat associated with the devil? I told you not to mess with that stuff.
I think the goat.
Juju.
I think the goat is apparently more similar to humans than cows, which
there's a rabbit hole there.
I'm not sure if that's significant.
You are tempting me so much, Mr. Walker. We got to move on. We have to move on, and it's your turn again, Claude. You weren't too happy with my net phone, but I believe there's reason for celebration with Webjet.
Yes, that's some good news for me, especially since I talked it up the other day on the podcast.
Just prior, you issued a buy. Well done, sir. A buy just before.
I was speaking to a friend today, and apparently the reception to my Webjet pitch was not unanimous support and agreement, which surprises me.
Haters gonna hate.
Surprises me.
Man.
I have to say, you guys did actually get me second guessing it as well. So. I was a bit lucky.
We're the haters.
I guess what I'm trying to say.
Is that what he's trying to say? You asked too many questions.
You did too well. You unconvinced people.
Hey, we're not trying to pump you, man. It's just a balanced view is what the three wise monkeys try to bring.
Goes without saying. Although I don't know if like balance out on the limb is always. Are we balanced or are we out on the limb? There are certain companies
where there's definitely no balance.
I think we're elegantly jumping from limb to limb. Anyway, so it turned out with Webjet because I got lucky and the thesis held true.
Well, what was nice about it was it wasn't just that it the shares went up and by the way, this is a 20% gain on the day. This isn't a small penny stock. This is $1 billion company that did this. But what was interesting about it that I'll give you absolute kudos for, it was the wholesale division, which was the cordial thesis.
I copied it. See, it always comes back to the wisest of the monkeys though, because I copied his. Matt,
did I say that? Did I?
Matt, no, come on. You're not fooling anybody.
You're the best looking, apparently. I heard that last week.
I'm the youngest. So anyway, what the wisest of the monkeys taught me was to look for inflection points. And I thought I spotted one on that the business-to-business side of things. Yeah. And indeed, it was true. It went from something like 5 million bit to 30 or whatever. So it's like, this just came online, baby. Nice. Here we go.
Very well done.
And wait. I need to tell the story.
Okay.
So then...
in the beginning.
Basically, the market responded to that. And their whole presentation, like, they knew what the good news was, right? There was like, the first slides were all B2B. Like, it used to be back in the day, when I was like following this for years.
Business to business.
It used to be the Webjet brand would be first and look at this great business. It goes up and up. Oh, a subtle difference. Now, business to business is the first thing on the slide. This is what we're going to talk about. And sure enough, if you look at the B2C, it's actually down, not versus the prior corresponding period, but versus the previous one.
Now,
the immediately previous period.
Yeah. And we touched on this in the podcast itself, though, but do you see that as the inevitable ups and downs of a cyclically exposed kind of business?
Quite possibly, but we talked about how I wasn't a fan of the I don't like pro-cyclical. I do like a bit of pro-cyclical for like a dabble. And
I like them when they're going up.
Yeah, exactly. I like them when they're going up, but I prefer stuff that's not pro-cyclical because also I'm emotional young monkey and like I don't enjoy a roller coaster. I like just a sweet ride. So basically, that worries me, and I'm actually very strongly considering basically packing my bags and saying, great, my little thesis is good, it was right, I'll sell. Now, the question is...
I'm going to challenge you on that. If you are right, And this is like what you're saying, the second largest player in this field in a global market, in a market which is still transitioning more and more online, where there's still a massive amount of market share to grow. Would that not suggest that there is much, much, much more upside potentially in 5-10 years' time? Well, the thing is,
if you look at some of Matt's other inflection point plays, like some of them obviously don't work out, but
edit that out.
Let's talk about those.
We do need to at some point. But the point is that a lot of them, they keep on doing strong growth for more than one half afterwards. You know, I feel like I'm one half into this inflection point growth of the business to business. Is it too early to say, great, you know, better sell now? Because even if there's further weakness in the business to consumer side of things, which look, honestly, there may well be, and even if that
it's going to be dwarfed by
this point, is it possible that once again this will be overlooked because the business to business side is stronger? So I'm really on the fence about this one at the moment. I'm not sure what I'm going to do. I may do nothing.
Right. I guess we better move on. 34 minutes in here. I'm going to round it off with. Did you have any final thoughts?
No, I mean, I think that's... I guess the one thing is also I've always wanted to have Webjet, at least some Webjet shares in my portfolio, because I just think it's an interesting Australian business that's managed to expand overseas, and I'm always a fan when they actually succeed overseas, and a lot of the companies we own have that in common. Ultimately, that begins to de-risk them over time, which is great to see.
That is a lovely opening for a nice segue here, because ProMedicus has its results out recently as well. And let's not labour the point here, because we've spoken about this ad nauseum. But very, very quickly, we had to update on it because they did have their results out.
We all own shares.
We all own shares in ProMedicus. Sales are up 59% from the previous corresponding period. All jurisdictions doing incredibly well. Strong double-digit growth. Bit of I won't go into the weeds too much here. There was some accounting changes, deferred tax adjustment changes. But even when you sort of normalize for all of that, and ProMedicus was very good in sort of, making that very clear, we saw an 80% jump in underlying net profit, which is really, really great. They saw, what's key for me here is we saw their margins expand from 48%, I think, in the preceding half to 52% here, with Sam Hubert, the CEO, basically saying, I think we can do more than that as well, which I think they can, because they are scaling this business incredibly well. Still debt-free, $24 million in cash. Here's a sign of their shareholder friendliness. They issued a lovely dividend, but then they added another 2.5 cent special dividend, probably because, they're just gushing cash and they're going to
I think it was to appease this guy from the AGM.
Well, yeah, right, and also because we know that these franking credit changes are going to potentially going to come into effect, and so it's a really nice way to sort of say, hey, we've got this big franking balance, we're going to return it to our shareholders, which is really nice. So I think that was really, really great. What's encouraging here as well, the pipeline is very, very, very strong. We know they get excellent win rates here, but they've had the largest number of leads that they've ever had. One of, again, just to sort of cut to the chase here, when we talk to sort of people within our circle, a lot of people that we tend to respect a lot, a very natural criticism is similar to my criticism with Nanosonics at the moment. Yeah, you can't fault the results, but it looks pretty. It looks pretty fully priced. I actually increased my valuation to a bit over $13. So I think you don't have to be too ambitious with this to actually make it make a great deal of sense. So it's not unreasonable to expect these guys to sort of grow that top line 35% or so for the next few years, given the margins that they're achieving, and given what a typical market multiple would be for such a strong company experiencing such strong growth. I think it's actually not an unreasonable assumption. So despite ridiculous PEs and the rest of it, I think that this one is much more sanely priced, but certainly not cheap.
Why did the shares go down?
Well, initially they went up and then they came back down.
Yeah, I don't know.
Because I think it's because like all the broker research, even the ethical equities write-up was like, what did I say? I said, I think there'll be a better opportunity to buy.
Almost without a doubt.
And broker research is coming out saying, yeah, it's a great company, but sell. But just because based on price.
Yeah, okay.
Which you can understand. And I'm sure there are funds out there that are like, this is a pretty big position now, and also on 100 PE or whatever. I think it's close above or lower than that, but around that.
Not to be too critical, but I mean, so many of these people who are putting this notes and research out there, they're just in a different game to us and the private investors that are listening, where they are are operating on very different time frames, and laziness is not something that is typically seen as a good thing, even though we know that longer term it tends to be something that is very well rewarded. Maybe patience is a better word than laziness. But anyway, I frankly, if this thing dropped back to $10, I would see that, even though that would hurt my portfolio a lot on paper, I would welcome that with open arms.
I could see myself buying around then, because I actually bought some around a little under $10, I think.
Yeah, we both did. I think.
And but then I sold like a little bit around 13 as well. Like, it's still my massive biggest position. Like, over 30%, I believe, at this time.
Yeah. You broke your resolution.
I did really
like
quickly.
2 weeks up.
I know, but it went up like 30% or nothing, and I was like, "Oh, come on! I don't know. This is a really big position."
We did a New Year's Eve episode, and Claude said, "My New Year's resolution is to never sell ProMedicus." 2 weeks later, I'm selling some ProMedicus.
I was a small.
It's longer
amount.
than that. It's like February, right?
Okay.
I made like at least a month.
That's longer than the average New Year's resolution.
My New Year's resolution was, I'm going to be a much more decisive seller, and yet I held on to Catapult as it continued.
It ran up into results, and I'm like, the market is pricing in just incredible results, and it's all. I was going into the results, and the company's doing great. Management is doing great. Like, it seems like not just management, but the whole group that forms the company seem to be doing a great job.
Yeah.
However, the price that the share market is saying is like, you guys are just incredible. You can never make a mistake. Everything will be perfect. And I'm like, I feel a little nervous.
This is the thing, It's like, you can actually do really badly on a phenomenal company if you just completely ignore valuation. So that therein lies the
also
challenge.
Some people completely ignore valuation and do really well as well.
That's true too.
That's not what we're trying to do. Just to be clear.
Wow, that was 6 companies, guys, and we kind of came in around 40 minutes.
Pretty good.
So I think everyone's a little bit surprised by that. Shall we put a pin in it?
Yeah, I just want to say thanks to all those that left some ratings and reviews. We did a call out for that a couple of weeks ago.
Really,
we got a lot of 5-star ratings, which is really nice.
Awesome.
Yep.
Thanks,
Mum.
We had a few reviews as well, so a couple here that I'd read.
Good.
JNF17 said, absolutely love it. 3 great and insightful personalities, which I thought was a bit
That's
much.
a bit ambitious.
Yeah.
Maybe 2 tops.
Matt, do you want to do this in ASMR, man? Like,
we had another one though that I quite like, because we haven't mentioned this on this podcast. From Alabella Netball Love, the title of the review was "Analysis Is," and the review for us was "Better than Catapult." So there you go. Got to mention both. But yeah, no, a few nice reviews and a lot of 5-star ratings, which was really good.
That was you,
and
wasn't
that's another drink as well.
That's another drink.
Yeah, no. So thanks very much.
Like, write in with the right companies, and then you'll get to drink at the end when we read them out.
And again, just so it's not too inside baseball, there's a long-running inside joke here that we just continually talk about ProMedicus and Catapult. So it's now become a drinking game.
But we're going to not do it for a few weeks, right? We've had results now.
And ProMedicus and Catapult.
Matt's like, right, guys?
No promises.
Yeah, all right.
All right, guys. Thank you so much for your time. Thank you, listeners, as well. We're the 3 Wise Monkeys.
And have a wonderful day wherever you are.
Wherever you are, have a great day, and we'll be back next week.
Thanks for listening.